And
the mouse is there.
okay, income statement, and then this one is the balance sheet, and then you have the cash flow statement. So the three of them will compose and then become the financial statements. And these three statements today we're going to go through from the beginner's point of view, and then I'll slowly introduce the concept about financial statements and the components, and also I will tell you, I will introduce how to analyze the annual reports, because after all, as an investor, we would like to analyze the annual reports ourselves. And then, yes, so let me begin with introducing this concept. So the financial statements is actually, you have these four building blocks. So in order to analyze well, the four building blocks include the liquidity and efficiency. And then because for a company, it is very important to look at the financial statement as in how liquid it is, or whether the cash flow is healthy and things like that. So this can be seen from the liquidity and efficiency, how efficient it is. And then number two is the solvency, the debt equity ratio, which I'll talk about it later. And then the market prospect. So this market prospect will be the qualitative of it, okay?
Okay, qualitative means doesn't involve number, right?
Yeah, doesn't involve number, because the efficiency, liquidity ratio, all these numbers, you are talking about number crunching. So the qualitative of it referring to the soft issue, where it's not numbers. And then the profitability, and profitability will be the heart and the core thing about this business, whether it is making money or not.
Yeah, and sometimes when we buy the company, we actually need to look at the futures. Right?
Yeah,
we're actually
right.
buying the company's futures.
Yeah, because a lot of often, right, people emphasize a lot on the numbers, and then if you were to ask me what is the percentage of looking at the numbers or looking at the qualitative aspect of the company, because for financial statements you have the qualitative, which is the talking about the quality, that means not non-numbers, and then you also have the quantitative. Quantitative refer to the numbers and the financial ratios. And if you were to ask me which one is more important, because a lot of people, they will focus too much on the financial ratios and numbers. In fact, I would think that it should be half-half, 50% and 50%. And then if you were to ask me how long, because if you're given 1 hour to analyze one report, how long are you going to divide the time between these two? I would say half an hour and half an hour. You should spend like 70% of the time into the numbers, and then you neglected the qualitative issue, because the qualitative issue will give you the direction of the company, which is the most important thing about that company itself.
I think the qualitative part is like a cost, and the quantitative part is an effect. Okay,
yeah.
If a business model and the management do not do well, then the numbers also show very poor readings, right?
That's right.
Yeah, so both also have to spend equating according to you.
Yeah,
right?
And also very importantly is that when you compare the financial statements, the numbers and the ratios, right? The numbers itself is meaningless unless you compare. You compare to what? You compare to intra-companies, that means within your company, or you compare with your competitors within the industry, or you compare to the industry average. Okay, so the numbers, always remember, the numbers that you get or you see is nothing, is meaningless unless you compare. You always have to make a comparison, then it is meaningful to you.
Okay, all right.
So next,
Yeah.
okay.
Yeah.
Okay. So when a lot of people, when they started to invest in the stock market, they may not have the financial background. So they may not be like accounting student or finance student, but they wanted to invest in the stock market because it is part of the wealth creation. So if you do not have the financial background and then you wanted to learn, and now we have this great opportunity, and then I'm going to show you the basic concept, and then even non-financial students, it's easy to understand. So the very first thing is that, let me introduce to you the concept. So for example, if let's say you wanted to do a business, okay, if you want to open a cafe, because nowadays a lot of young people, they like to open a cafe. So if let's say you want to open a cafe, the first thing is, what is the first thing that you need to get or to raise? What do you think? If let's say you want to open a cafe, the first thing.
I want to know whether the locations got the traffic.
Okay.
People want to eat the food there. Want to serve or not.
Yeah. So suppose you found it, and then isn't it you need the money? to start a business?
Yes, definitely.
Okay, so the first thing is your capital. Okay, so I'm going to talk about the sources of funds. So how many types? So if let's say the cost of starting a business is 100,000. Okay, so for 100,000, let's say you only have 50,000. So you come up with your own pocket money, 50,000. Then how do you get the other 50,000? So you probably have to
Borrow.
borrow. So you see, when you're looking at the sources of fund, it is either from your own pocket money, which is the equity, which is your capital, or from borrowing, which is the debt. So this is in fact the part of the balance sheet. Okay. So you look at this balance sheet. It is very far. Okay. If I can draw something here. Wait. Okay, I want to draw, but it's okay. So if let's say you want to borrow money, and then 50% is borrowing money, and then 50% is raising from your own pocket money. So there you are. You have the money capital from two sources, which is debt and equity.
Where you want to highlight?
Actually, I wanted to draw something.
Okay, you can draw now. You can draw.
Okay. So this is the balance sheet. Okay. So this is the balance sheet. So over here, you can have the 50K from your borrowing debt, and then you have another 50K is from your own money equity. Okay, so now you've got 100,000. So with this 100,000, you wanted to start the business, and then you need to buy the equipment and the fixtures and fittings, the tables and everything, and renovation. So all these will be into this part over here, which is the fixture and fitting, and then the equipment and everything. And let's say, for example, you spend about 80K. Okay, 80K. Over here, you've got 100K, right? So over here, you've got 80K. The balance is 20K. Okay, so this 20K you put in the bank, cash, asset. So over here, do you see that the money from the left-hand side, right-hand side is actually the sources of funds. So the money from the right-hand side over here, these are the sources of funds coming into business, coming into this company, and then putting into the assets. You buy assets, and then you put in the bank, which is also an asset. So over here, you can see that the balance sheet is balanced. 100K is equal to 100K. Okay, so it's very simple. So this is a basic that you need to understand. Then we look at the income statement. Okay, so for now, this balance sheet tells you your position. Okay, your assets and liabilities, the position of the company. Now, if let's say you started the business and then you run into money daily operation, and then every day you receive sales revenue, and then at the same time you also incur costs. So all these operating activities, right, will be recorded in the income statement, and this will give you the profits. Okay, so for profit, it's in the P&L. Okay, so profit comes in the P&L statements. So whatever money that you have, whatever sales that you can get from your cafe will be recorded as sales, and then you have to minus the cost of goods sold. Okay, cost of goods sold. Cost of goods sold refer to the supply of the coffee beans or the raw material that help you to deliver this business. And then sales minus the cost of goods sold will give you the gross profit. Okay, so this gross profit is actually the gross profit that you have to cover all your expenses of running this business, including your marketing, your labor, your electricity, all your utilities, and rental and everything. Then you only derive this net profit. Okay, net profit. So when you get this net profit, how do you relate back to this balance sheet? So when you got this net profit, your cash reserve has increased, right? Because your business is doing well. So your cash increased, and then your retained earning over here also increased. So there you are. Let's say you have a 20K of profit. This becomes plus 20, and then this becomes plus 20, and then becomes balanced again. So then you are relating this profit, the P&L, into this balance sheet. So when you make money, your balance sheet, your asset will look bigger in value. So when you lose money, then your balance sheet, your retained earning will reduce. Okay, so this is how it is related. Okay, then this example that I'm giving you is the financial position, which is another word for balance sheet, is financial position of a company. So I'm looking at this hypothetical or this example, a public listed company from our Bursa, which is Hapsing. So it's a very simple business, and then you can see that the financial position is you have assets, okay? Assets, and then assets, you have fixed asset and current assets, and then you have the followed by current liabilities, and then the long-term liabilities. Long-term liabilities, they also call it non-current liabilities, become long-term. And then you have the equities. So this comprise the balance sheet. Okay.
Okay, so can you tell us what is cash flow statement?
Okay. So when we come to the cash flow statement, so this cash flow statement has record three activities, okay, of the company. Because just now when we look at the income statement sometimes when we do business and then we have accrue sales, and then we have accrue expenses. So all these actually is non-cash items, and then we have depreciation. So all these are non-cash items. However, if let's say you want to know the actual cash flow of the company, right? So this cash flow statement will give you a clearer picture. So the first section here is called cash flow from operating activities. So this is the core activities of the company. So whatever the company is doing in terms of the operating the business. So over here you can see the working capital, the money coming in and money going out for all this operation. So this is the core activities and the core income or the inflow of the money coming in over here. Okay. So if it's a positive, it's very healthy. If it's a negative, that means something is wrong in this company. They are not making money. Then the next one is this cash flow from the investment activities. Investment activities refer to the buying and selling of the plants and equipment. So for example, if this company is expanding, so of course this company has to buy plants and equipment. So therefore, you will see that this section here, you have a negative. That means money going out to purchase the equipment. Okay, so when you're expanding the business, you have to buy, you have to buy the equipment, then you have to reduce this cash flow over here. Sorry, I need a glass of water.
No problem.
Sorry.
All right.
Have a bit of a cough, sorry. So,
is it better?
Yeah. Then so just now I have said that we have the cash flow from the operating activities. The second part is the cash flow from the investment activities. Then the third part of this cash flow is cash flow from the financing activities. So for these financing activities, it is the if the company is having to pay out dividends, this can be shown in this financing activities here. Or if the company is changing anything to do with the, remember just now we said the balance sheet, the right hand side, we have the debt and the equity, sources of funds. Okay, the sources of funds. Anything to change with these sources of funds, right, will be reflected in these financing activities. Okay, so anything to do with these sources of funds, the changes in the sources of funds will be reflected in this financing activity. So if you raise a right issue, or if you have to pay down, pay a dividends, or whatever, so all this will be reflected into this. So if let's say you borrow money from the bank, okay, borrow money is also something to do with the debt and equity, right? It's the debt. So the money coming in. So then you see a big increase in this section here. Okay, so for cash flow statement, this is the three important section, and I would say that among these three important sections, right, the most important is the operating cash flow, because that's the core thing about this business.
Yeah, because if the company don't have good and positive operation cash flow, then they are not receiving cash.
Yeah,
for products and services that
when they keep borrowing money, although the cash flow looks good, but then if let's say they keep borrowing money and then to finance that operation, that's a very bad situation.
Yeah, right. So before we proceed, we just want to launch a poll to see if you have been listening and paying attentive attention. So on your screen right now, there is a poll, and what you need to do is you need to fill up this and let us know whether this is income statement, balance sheet, or cash flow statement. So the poll is, which financial statement tracks the profit and loss of a company? Okay, is it income statement, is it balance sheet, or is it cash flow statement? All right, I give you another 20 seconds or 15 seconds, okay, to give us your answer. Okay, so we have 64% of you voted. Give it another 5 seconds. All right, so let me close the poll and share with you the result. All right, so on your screen, you see that 66% of you pick income statement, 23% of you pick balance sheet, 12% of you pick cash flow statement. All right, Pauline, would you want to review the answer?
Okay, the answer is income statement.
The answer is income statement.
I'm surprised some of you put it in the balance sheet. Oh no, probably you misunderstood the retained earnings. Is it?
Right. So the answer is income statement. So an income statement keep tracks of whether the company makes a profit or make a loss. All right. So let me go back to the slide. Okay, now before we right now we know that financial statements are important, and just now we covered. Let me briefly summarize. We covered 3 financial statements. Number 1, we talk about income statements, which sometimes is called profit and loss statement. And number 2, we talk about balance sheet.
Yeah.
And basically, what I understand from you is that income statement is the one that keeps tracks whether the company is profitable or not. So if you want to see income statement, we know that if a company makes profit, it is healthy. If a company loses money and it's make loss, it's not healthy.
Yeah.
Right? That's the first statement. The second statement, balance sheet, keep track of 3 sections. Number 1, keep track of the sources of fund, which is composed of liability or equity. Equity means the money that I put in myself. That means that the money that I raised from the bank, from bank loan, which is a liability to the company.
Yes.
And the third part is the asset. Okay, so the balance sheet keep tracks of the wealth of the company.
Yeah.
So you want to see if the company is wealthy or not, look at the balance sheet.
Yeah, that's
right. If they have a lot of assets, a lot of debt, if they have a lot of equity. But the whole idea of running a business is to grow the equity segment.
Yeah.
Okay, so the equity keep growing, and the shareholders can have more returns from the investment.
That's right.
So that is our second financial
Because
statement.
the retained earning is in part of the equity, the retained earning.
Yeah.
So the retained earning keep track of the profits.
Yeah, correct. So so that's what I understand from you, which is the second part. A balance sheet keep tracks of the wealth of the company. If you want to see the company is wealthy or not, how much asset they have, how much debt they have, look at balance sheet. Okay. And the third thing I learned from you is cash flow statement. Okay. Cash flow statement is a statement that keep tracks the day in, day out of the cash. How much cash comes in for the operation activity, how much cash is going out to pay dividend, how much cash is going out to pay to invest in capital expenditure. So that's where you look at investing cash flow, operation cash flow, and financing cash flow. All right. So these are the 3 financial statements that Pauline had just covered. Now, I want to move on to the next topic, which where can we find these financial statements?
Yeah. So for the public listed companies in Malaysia, we have to, in fact, in all over the world, every year you have to publish annual reports. So this is audited annual reports that you need to let your shareholder know what is happening for your company, for this company. So
how do we read annual reports? Like, annual report is very thick, right?
Yeah,
then when I also invest in company and every time I receive annual reports, 200 pages. So how do you dissect an annual report?
Usually, for me, I will have to go into the financial highlights. The first thing is the financial highlights. But let me do a brief introduction of the annual report. So annual reports contains 2 parts of it. So the first part is the qualitative of it, where you can see the CEO statement and everything. And then the second part is the quantitative. Quantitative refer to the numbers. Then you see the 3 statements that you saw. Okay, so the number crunching. So in order, just now I said, in order to have a clear understanding or proper dissect of this company performance, you need to spend more time on the qualitative part. Okay, so usually I will read the qualitative, the CEO statement, and then the prospect of the company in details, and then I will go through the numbers as well, because numbers every year keep changing because of the situation, environment, challenges. The numbers will keep changing, but however, the management team will not change. The management team will try their best to perform the company and then deliver the return to the shareholders. So I would think that the qualitative part is more important than the quantitative part.
Right. So like if I were the chairman or the group CEO of a company and I were to prepare the group CEO statement or chairman statement, I would usually want to show the good side of the company, right?
Yeah.
Like how do you read between the lines? Like
so I'm going to show you one demonstration about this company,
right.
and then we'll go through, and then I will explain from there.
Sure.
Okay, so for the qualitative aspect, we started with the CEO statement. So this usually the chairman or the CEO will have a 1 page whereby you can read their company, and then over. Okay, so over here usually will be they will talk about the company P&L, the prospect, and then what are the big idea, big vision of the company. So in order to get the big vision idea about the company, you come to this first page, okay, so that you can get what this management, their vision about this particular business. Then you look into the corporate structure. So this corporate structure, at least you know that this company, they have how many subsidiaries and to what extent are their business expansion. So then you have a big idea. Okay, so for example, this company, you have subsidiaries and then into food industry. So this is Hup Sing is a famous cookies, I mean not cookies but biscuits industry. Okay, talking about consumer sectors. So then you have a few headings. So the introduction over here, they will explain to you the history about this company. So over here, you can see that the history is that this company has been in the business for 59 years. So you can see that this is a very old traditional business. And then they're selling what? They're selling biscuits, crackers, cream sandwich biscuits, and those crackers that all of us grew up with this type of biscuits when we were young. So their product is a very established brand. And over here, you can see that they will tell you what are their product lines. So basically, their products are very simple. They have biscuits, they have beverages, and then they have agents products. So that means they are also the agents for other products. So for example, would be the rice crackers and others. Okay. Then they will also explain to you what are the product range. Because when you invest into a company, you're actually looking at the business itself. It's not so simple. You just hearsay and then you invest. You need to really look and understand the business. So Warren Buffett always said that when he buy into a shares, right, he's actually looking at buying into a business. So now we are looking at the annual reports, and then we are looking at what kind of business is this company is doing. So over here you can see that the business range, and then they said that they have this famous brand is called the Chuck Ping Pong, and then the Hup Sing cream cracker. So these are their most famous brand under their line. And then for the beverage, they also have beverages. Beverages will be the most famous one is the instant coffee mix. So all these names are very familiar with all of you, I'm sure, because I saw these names everywhere. So you can see that this company, they are doing a very traditional business, and then with the products well received by the people. And he also sell other Asian products. For example, for the kids, they will know what is Wang Wang biscuits, Wang Wang rice crackers. So these are the favorites of some of the kids.
Yeah, okay. I think I'm one of the biggest consumer.
Yeah. Then we also look at the overview of the business. So overview, you can see that overall the revenue, these are the fine lines that you need to catch from here, whether this company is doing well. So the revenue grew 5%, okay? Or the revenue, whatever. Then the profit, okay? The profit after tax, however, decreased by 10%. So you see the revenue has increased, but the profit, net profit has reduced by 10%. So what does that mean? That means your cost has increased. So over here, either your selling price has reduced or your cost has increased. So over here, it says that no selling price increase. So the price still maintain the same, but the prices of major raw materials have increased. And then you look at the fine lines here. Among them are the palm oil prices have exceeded those of previous years on average by about 10%. Sugar increased by 10%, milk powder increased by 29%, oil-based products increased by 42%, and coffee 16%, tea 2%. So all this. So you can see that they are operating in a rather challenging environment with the raw material price increasing, whereas they cannot increase their selling price, so they have to absorb the cost. Okay, so that explains why the profit reduced by 10%. And so over here, it's also very transparent. They tell you the reason, and it says the operating environment is expected to remain highly competitive. However, the group is ready to face them by maintaining and improving our quality coupled with more aggressive promotion planning. So they're going to increase their sales. So these are, I would say that this management is very honest and transparent. So it could give me a good impression of this company as well.
So usually when you see, like, I think in a lot of annual reports that I read, sometimes you're right, the external environment remain challenging or remain highly competitive. So if you see these kind of words, what is your take? Would you still consider this investment?
Yeah, of course. Currently, we are all operating in a very challenging environment because of the global. You see the weaker demand from the China side. However, if you were to look at this business, the external environment is challenging, and then it's not under their control. They cannot control the external environment. What they can control is their internal. Okay, maybe what they can do in facing this challenging environment, if they have the effort to reduce the cost or to make it more efficient, they will spell it out in the annual reports, and then so that the shareholder will see that, okay, this company is taking effort to maintain the efficiency, to raise the efficiency, to raise the productivity, or to reduce the cost, maintain the cost wise, and these are the steps that we want to see in order to see whether they can cope well with this challenging environment. Yeah. So over here, they will see that, okay, the outlook of the future prospect. So we'll see what are the outlooks of the future prospect. So they say that the cost is their major concern, and then they still see that it will continue to be pressure. However, they are saying that they may optimize the business, and then they may go for increase the supply chain. So that means they want to increase their marketing outlets, and then hopefully can increase their sales. Okay. Then over here, I think they also talk about their exports. So the business operation review, okay, so you can see that this company, domestic-wise, is about 71%, okay? The exports is 29%. So they are actually trying to increase the exports over here, okay? The exports slightly increased by a little bit. And domestic sales registered an increase of 4%, export sales registered an increase of 8%, okay, which is mean that they really want to grow their exports, which is good, because in any business, when you're talking about globalization, if you can sell to exports, you can increase your market share, okay? Okay, then the production side. For the financial year ended, so the average operating now, so over here you can see the capacity here, capacity utilization, because in a manufacturing company, it is important to look at their capacity utilization. So if you are operating at 82%, I would think that it is quite healthy. You wouldn't want to see the numbers like below 50% or even below 70%. It is not so healthy. However, it also depends on the industry. So I would think that this 82% is okay. Okay. And so they are thinking of having a new cracker line in replacing the old existing line. So all these are their plan. So which gives us a clue of how active or how productive that this company is currently doing. Okay. Yeah.
So after we have learned qualitative aspect of the business, which doesn't involve number at all, when you look at the company business model, look at how how is the production, what is the production capacity, who are they serving, what kind of product that they have, and who are the management. So these are all qualitative aspect of business. So when you invest in a company, the first part is you don't really need to be number sensitive. Am I right?
Yeah, that's right.
Yeah, because you only look at the business. What you need to do, what you need to have is probably business acumen.
Yeah, that's right.
See, are there more people buying crackers, or are there less people eating crackers?
Yeah, actually, it's a lot of common sense. If you look around, if you see people are still consuming the product, okay, you know that it's fine. However, if let's say people surrounding you are switching the habit of not consuming that particular product and then switching into another product, then you know that, okay, this business, the sales is going to be affected. Okay, so you have to use your own observation as well. So a lot of time it's a common sense as well.
Yeah, so even though you are not number sensitive, don't worry, because half of the race is won already without having to learn number.
Yeah.
Okay, that's qualitative. So even if you are, let's say you're a housewife, okay, maybe you're not that number sensitive, but maybe you can observe, okay, like which product you will buy more, okay, because you buy consumer goods all the time, okay, because maybe you're a housewife to look after the welfare of the household, so you can observe. So even though you are only a housewife, you can also become an investor.
Yeah, that's right.
Am I right? You see, today we have a woman, okay, incredible woman investor with us today to share with you how she became an investor.
Okay.
And so after we learn about qualitative aspect of business, can you tell us more about quantitative aspect of business?
Okay. Now we come to the second part of it, is the quantitative analysis, whereby we look at the numbers. So usually for the annual reports, the first few pages, they will give you a summary. So usually in order to reduce your time to analyzing the numbers, right, the very first thing is that you must look at this 5-year financial highlights. So financial highlights, you must see that the trend must be up. Okay, so this is a chart whereby they will show you the past 5 years how this company is performing in terms of revenue. So if you see that the trend is up, okay.
If the trend is not up but is erratic, would you invest in that kind of company?
I will have to find out what's the reason. Okay, if it's erratic, is it because of the competitors, or is it because of what is the reason? So if it's because of the competitors, then I probably will have to rethink about this company, because that means they are not the leader, they cannot fight with their competitors. That means their market share is in trouble. Yeah. So this is the first step, and then I will also look at the profit after tax. Okay, so you can see that the profit after tax sometimes is due to their cost structure, or sometimes it's due to extraordinary items and things like that. Then that's why you have some erratic. And just now over on the first part, they have already mentioned it's because of the cost. The raw material price has increased so much. Then the return on equity. Return on equity is ROE. ROE. A lot of people, especially for those who are the Warren Buffett follower, you will know that Warren Buffett said that he wants to invest in a company with ROE of 12 to 15. So this is the guideline, because different industry will have a different ROE, but in general, 12 to 15 is a very healthy percentage. So it's actually, ROE is actually the return. Return means the money that you make. Okay, so it's a net profit return divided by your shareholders fund, your equity. Okay, so it's the return on the shareholders itself. So this is it's like, for example, when you invest in a business, you want to see what is your return for you. So this is numbers to look at. ROE, return on equity.
Like if you invested like 100,000 as capital to the business, if every year the business is making you 10,000, then the ROE is 10%.
Yeah, that's right.
Yeah, so that's ROE.
Then also you have the earning per share. So earning per share, I would, if possible, try to memorize the earning per share, because earning per share is the formula for the PE ratio. When you calculate the PE ratio, right, it's your current market price divided by the earnings per share. So every quarterly, they will release this earnings per share figure. And then with these changes in the earning per share, the PE ratio will instantly reflected. So if let's say, and to calculate the PE ratio, maybe I illustrate to you. I'm sure many of you have heard about PE ratio, right? PE means price over earnings. Okay, your current market share price divided by your earnings per share. So this is the earnings per share. Okay, earnings per share means that how much you earn divided by the number of shares. So that means on each share, what is your earnings in how many cents? So over here, this company, they have 5.6 cents. Okay, so this is earning per share. Now, why I say it's important is because for the calculation of this PE ratio, you need to use the market price, the current market price divided by the earnings per share. And this earning per share, right, is 1 year. 1 year, that means it's made out of 4 quarters. 4 quarters, okay? So if let's say, you know that every quarter you have the earnings results released. So every quarter you have a new earnings per share figure come out. So in order to calculate the 1 year earnings per share, right, you need to add together the latest earnings per share for this quarter plus the previous 3 quarters. So make it up into 1 whole year. Okay, so this is called rolling quarters. So then you can calculate the adjusted this PE ratio immediately, because after all, the investors, the analysts, everybody is looking at this PE ratio. So this PE ratio will instantly affect your selling price. Okay, so this PE ratio will affect your selling price. So for example, if your earnings per share increase, so when your earnings per share increase, right, your PE ratio will increase or reduce. Okay, your PE ratio will reduce because the bottom is the denominator. So denominator increase, so the whole thing, the PE ratio will reduce. So therefore, when this PE ratio reduce, right, then investor will think that, oh, it's cheap valuation, then have to go in and buy. Then the price will go up further. Okay, so therefore, this earnings per share, very often it will affect the valuation of the price instantly. Then you also look at the net dividends per share. The net dividends refer to your investors' take-home money. Just like you put your money in the FD, the FD will give you the interest rate, okay, the interest. So this one is like you putting your money in this company, and then this company will give you the interest. But in this case, it's not interest, but it's called dividends. So the money, yeah, the yield, that money you put in your pocket, okay. So for shareholders, share investors, especially if you are long-term investors, I would suggest you to look at this net dividend per share. Very important, because after all, if you do not put in the stock market, then you put in the FD. So you're comparing to the FD rate. The FD rate is 3%. Then what is this company is giving me? Is it more than 3%? If it's more than 3%, it's worth for me to put in this company for long term. Then you must also look at the dividend payout ratio, because this dividend payout ratio is essentially saying that, okay, this company is earning so much money, okay, so out of this amount of money that the company made, how much it is allocating to the shareholders as a dividends, the payout ratio. Okay, so if let's say the company is earning 100% and then give out 80%, so that's good, fine, because you are giving out less than what you earn. However, for this particular case, you see that this company is giving out more than 100%. So that means what? That means whatever they earn, they give it to you, and then they take the return earnings and then give it to you as well. So that means they're taking more than what they earn and give it to the shareholders. I would say that this pros and cons, because for the dividends as the shareholders, of course, you are very happy because you are receiving the money. However, this company, the share price doesn't move much. Okay, forever
if it's one already.
Yeah, you saw the price already. Yeah.
I observed this company before. But sometimes there are companies who borrow to pay.
Yeah.
That is really.
Yeah, that's not healthy at all. Because it's not sustainable. How much you can borrow if you keep paying? If you keep pleasing your investors, how much you can? How long you can sustain? It's not sustainable. Okay, yeah. You have to pay a price.
So next time when you see a dividend payout that's more than 100%, you need to really be careful and study more in detail.
Yeah, it may not be sustainable. Then they also have a financial highlights, and then they will list down all the important key ratio. So over here you can see that they have. Over here, I would think that the most important is the growth rate. okay, the financial ratio as the growth rate, because you want to know that whether this company is growing. So you have the revenue growth rate, and this is for the past 5 years. So you want to see that you have the revenue growth rate. Okay, there's a negative here. That means the revenue is not increasing. Then you want to see the net profit growth rate, also a negative here. And then another negative, 2 consecutive negative for the net profit growth rate. And then the net profit margin. So this net profit margin is also very, very important, because after all, you want to see whether this company is making money. The very first thing that you want to invest in this company is make sure that this company is making money. If this company has a net profit margin of 14.8, that's fine. 14.8 is still okay, but however, you need to compare to the industry. But for consumer sector, 14.8 is on a bit of a low side. If preferably, I would prefer 20%. However, if you are looking at the plantation industry, plantation is usually single digit. Okay, it's below 10%. So you can see that for this certain industry, in order to make money is so difficult. It's only like 6% of profit margin, 5% of profit margin. So this kind of company usually I will not invest, because so difficult to make the money. However, if let's say this particular company, I do not want to name the name because I don't want to recommend stock, has a 50% of a net profit margin.
Wow.
Yeah, stop it. I don't want to name.
Okay.
So with the 50% of a net profit margin, isn't it? You look at the business model. That means this company is able to cushion the if there's a recession or anything, it is able to cushion the challenges. Okay, so with a higher net profit margin, you are able to absorb all the adverse challenges ahead. Okay, easily. Okay, so I would prefer those companies with a higher net profit margin or gross profit margin. Then you have the return on equity. The return on equity is still progressing well, which is on 20% and above. Yeah, then you have the earnings per share and things like that. So the important is the growth. Okay. The next one. These are the financial ratios to measure a company's health, because this webinar, we are talking about from scratch to pro. So just now we mentioned about the very beginning basic idea about financial statements like balance sheet, income statement, and things like that. So now we are slowly entering into pro, because when you're talking about pro, you are looking at these ratios. Okay, so these ratios, you can see what quick ratio, current ratio, all these are accounting terminology, right? So in fact, if you were to look at these are numbers that you can refer to. However, and every quarterly, they are also changing. So, but you need to compare with the industry as well. So to look at the situation of the company. So essentially, the quick ratio, current ratio, all this, right, is measuring the working capital wise, how fast it is turning the money around. So for example, when you go to a restaurant, when I go to a restaurant, right, I would usually time the waiter, from ordering till the food arrive till I finish eating. What is the cycle? Like how long does it take? So if let's say I go to a restaurant and then I order and then it takes a long time for the food to arrive, I would think that this company is not efficient. This restaurant is not efficient at all. The turnover table, right, is very slow. So if you are doing business with such a slow turnover, right, how to make money? Okay, so so same here for here is your working capital. You must have you cannot have too prolonged kind of drag for too long. You cannot let your supplier drag you for too long. That means your turnover has to be healthy, has to be quick. Then you are doing a proper positive kind of a business. Okay, then the liquidity ratio refers to your this one refers to your supplier paying you back, and then your stock, how much you stock up your stock. Is it like you are stocking up for too long? How long does it take for your stock to move out of your warehouse and then go to your customers? So you do not want to have a kind of a too long kind of inventory in your warehouse, and then you also want to make sure that your debtors paying you back promptly. And then of course, when you pay your supplier, you don't have to pay promptly, but make sure that you collect money have to be prompt. Okay, then the capital structure. Capital structure, this one refers to debt and equity. So I wouldn't say that if you have a high debt company, it is bad for the company, because it also depends on the industry. Because certain industry, your assets and your machinery, heavy machinery, that you require a lot of borrowing to buy those equipment. So it depends on the industry. However, in general, we would like to see that a company has as little debt as possible. However, if you are in a low interest rate environment, even if your debt is high, and then if you can borrow the money to use that money to make more money for that company, it is justifiable. So it depends on the environment, the interest rate. If the interest rate environment is low, it is okay. However, if let's say you are talking about interest rate is rising, okay, and your debt level is high, then this company is in danger. Okay, I wouldn't, in such a case, I wouldn't want to invest in such a high debt company. Okay, then next we look at cash is king. Now, just now we mentioned about the cash flow statements. So you still remember we mentioned that the 3 parts in the cash flow statement. So the 3 parts of the cash flow statements, they are the cash flow from the operation, the cash flow from the investment, and then the cash flow from the financing. So for these 3 categories, right, sometimes you see sometimes the cash flow increase, sometimes the cash flow reduce, right? So I want to test you, see whether you understand or not. So if let's say you see that there are 2 companies over here, okay, having a cash flow statement, and then for company A, this company, right, you can see that the cash flow from the operation is positive. Okay, so that means he's getting cash flow, having a positive figure from this operation activities here. And then for the investment activity, it is a negative. Okay, just like we said, when it is a negative, it means what? When your cash flow from this investment activities is a negative, it means that you are actually investing. Okay, so when it's negative, it means that you are buying something, buying the equipment, fixtures, whatever. Then you see the cash flow from financing is decreasing, negative. So it means what? So either you are paying down your debt, okay, money going out, or you are giving out dividends. Okay, so it is negative. Okay, then another company. So this company, it has a decreasing cash flow from the operation. So
that means negative.
Negative, yes, negative. So that means what? That means more money is going out than coming in. Okay, from operation, and then this one is investment. You have a positive. Just now over here, negative means that you are buying something, right? So when you have a positive over here, it means what? You are selling your assets. Okay, you are selling your assets, then you can get the money from this section here. Then over here, you have increased or positive your cash flow from the financing. That means what? Either remember I said from the financing is referring to the sources of funds, right? So the sources of funds refer to what? Your debt or your equity. So obviously, this company is raising fund from the debt side or the equity side. Okay, either he borrow more money or he having a right issue, having raise the capital. Okay, so out of these 2, A and B, okay, these 2 company A and B, which one is healthy? Which one is healthy? Anybody?
Okay, if you think it's A, you type in the box and say A. If you think it's B, you type B in the chat box. Okay, let me see. Wow. Okay, a lot of you answer A.
Yeah, good.
Okay.
You are listening. Okay, good.
Correct. So the answer is A.
Actually, the very core thing, right, is this cash flow from the operation. That means this is you are having your operation of your business is healthy because your money is coming in.
Yeah.
Yeah.
For those who pick B, it is not that correct, but never mind, you still make an attempt, okay?
Yeah,
to answer
that's right.
that.
Okay.
But because the thing is that the operation cash flow is actually negative, means they not only don't have the net cash inflow of the company, they have a net cash outflow from the day-to-day operation. So
And
that is
they're selling their assets to finance the cash outflow. That's the worst thing.
yeah. So before we proceed, let's launch another poll to see if you have been listening attentively. So let me just launch another poll. Now on your screen, I'll ask, which of the following analysis is important to do when you study annual reports? Please pick number 1, number 2, or number 3. Okay, is it qualitative? Is it quantitative, or is it both of the above? Okay, please take 20 seconds to write down your answer. Okay. All right, so give you another 5 seconds. Okay, let me close the poll now. All right, let me share with you the answer. Okay, the answer is 89% of you pick both of the above, 8% of you pick qualitative, and 4% of you pick quantitative. So what is the answer, Pauline?
Oh, okay. So 89% of you are correct. So it's both of the above.
So both qualitative and quantitative are important when you study.
I want to see 100% correct answer. Do we still have a chance? Another question or not? No. Okay. So the next question, I must see 100%.
Okay, that's the benchmark, huh? Okay, but anyway, let's go back to our slide.
Okay, so the next one, you always hear people talking about free cash flow. So what is free cash flow? So free cash flow is actually talking about your first section, which is operating cash flow, minus your second part, which is your capital expenditure. So then you have the first section there, the operating cash flow from the operation, minus the cash flow from the investment. Then we'll give you the money. Then this money is called the free cash flow, because this free cash flow will be the money able for you to give to your investor as dividends, right? The dividends. Okay, so this is free cash flow. So why concern the investor? Because after all, you want to receive the dividends. So I want to see how much free cash flow I have, so that the possibility of getting big dividends is high or low. Okay. Then next we look at the valuation of a stock. So for the valuation of stock, we look at three aspects. Okay, the first one is you are looking at the book value. Okay, that means the valuation, meaning that this company, you want to know, okay, how what is the value of this company? Is this selling at 10 ringgit? Is it high, overvalue, or undervalue? Okay, so you have 3 levels of this valuation. First, you can look at the book value, which is the net book value. Over here, which means the net tangible asset. Okay, all the assets minus all the liabilities give you the net book value. So this one is historical. Okay, this book value is historical because it's already appear in your balance sheet, and then it's audited report, and then it's in a historical manner. Okay, then the next one is market value. So this market value is actually referring to the current market price. Okay, the current market price times the number of shares, which is the market cap as well. So this market value is current, the valuation of this company currently. So this market value can be due to demand and supply. Okay, the daily movement of the share price gives you the current valuation of this particular company, 10 ringgit, for example. Okay, the book value, the net tangible asset may give you 8 ringgit. However, now people are paying 10 ringgit for this company because they may think that the future prospect of this company is higher, so they pay more than the book value. Okay, so this is the market value. Then the next one is the intrinsic value. The intrinsic value is the future value of this company. You are looking at the future cash flow discounting back to the current situation. So you are looking at the future prospect of this company. So a lot of people, we cannot calculate the intrinsic value well, except Warren Buffett, because he is able to calculate the intrinsic value and then to get the undervalued stocks. through the intrinsic value. He know, because intrinsic value is not so simple that you discount the cash flow back to the present value. But even though when you discount the cash flow, like, in order to derive the future cash flow, you need to have some estimation. If without a certain level of experienced investor, right, you wouldn't be able to estimate the cash flow so accurately. So that requires a lot of experience, which is very tough.
Do you often calculate the intrinsic value of a company?
Because I will give a guesstimate meaning that, yeah, I will estimate it. However, in terms of actual value written down, it's not like a real value, but more like an estimate. Yes.
Yeah, like because intrinsic value is a very tricky thing in such a way that there's a lot of assumptions and projections needed. For example, what's the growth rate, what's the discount rate, and if a company has a very cyclical kind of in a cyclical kind of industry and have erratic growth, sometimes first year 100 million profit, next year 40 million, following year 200 million profit. So it's very hard for you to estimate the growth rate.
Yeah, that's right.
So intrinsic value calculations sometimes do not work in all kind of companies. It only work in a certain kind of company who has a stable growth, and it's easier for us to do to estimate the growth rate and estimate the discount.
Especially the technology, I think it will be very difficult to get the intrinsic value of a tech firm, because you never know what is the potential of this technology company, and it's very difficult.
Right. So now before we move on, because you asked for poll, so we'll just launch another poll. All right, let's do something.
100%.
Right. This one is
okay.
Asking about free cash flow. What is free cash flow? Is it number one, cash generated from operating activities? Number two, cash generated from investing activities? Number three, cash generated from financing activity? Or number four, is it cash resources available for distribution to shareholders? Please answer this poll. All right, 50% of you voted. Give you another 5 seconds.
8 seconds.
All right, let us close the poll right now. Okay, let me share with you the answer. Okay, now 16% of you pick A, is cash generated from operations. 2% pick investing activities. 2% of you pick cash from financing activity, and 80% of you pick cash resources available for distribution shareholders. So what is the answer, Pauline?
So 80% of you are correct. So it's the last one.
So we still have majority of you
Cash
correct.
attributable to pay dividends, which is the shareholders.
Yeah. So no worries, please understand some of them are really beginners. So haven't hit 100%, but God willing, one day we will meet 100%. Okay. Now maybe we should talk more about this free cash flow. Okay. Now I understand that it is really hard. It's really harder for us to understand free cash flow. But from the definition that you just put across, that what are the cash resources available to distribute to the shareholders. So when we calculate free cash flow, is essentially we're taking the operation cash flow and minus
the investing,
the capital expenditure. So if any cash generated from operation activities, so long that we minus out whatever that we're going to invest for the future, the remaining cash is the one that we can distribute to the shareholders as a form of dividend. So if you are a dividend investor, free cash flow is something that you want to look for. However, it's not as straightforward because you can't find free cash flow in a financial statement. You can only calculate it yourself.
Yeah. Unless some website they will provide the free cash flow ratio, then at least over there you can see.
Yeah.
But this is something that you may need to calculate yourself.
I once learned these phrases which are very powerful, and I want to put it across to you so that you can dissect it yourself also.
Okay.
So they say that the net profit is accounting profit. It's an accountant profit. The operation cash flow is a business net profit.
Oh, okay.
And the free cash flow is the investor profit.
Ah, good.
Okay, does that make sense to you?
Yeah, it makes sense.
Yeah. Let me repeat.
Mm,
The net profit is an accountant profit. That
Yeah.
means the accountant see net profit. Oh, this is
yeah.
the profit.
Because of the accruals and
Yeah,
everything.
Correct.
Mm.
And the operation cash flow is a businessman profit.
Yeah.
Because that's where businessmen collect all the
Mm.
cash from a company that is not considered a non-cash
Mm.
items such as depreciation,
Depreciation.
amortizations, and so on. And lastly is the free cash flow.
Yeah.
It's investor profit. So when you invest in the company, we essentially invest for the future and the future streams of the dividend. So
Yeah.
how much the company makes and accumulate in the form of generate in the form of free cash flow is the one that will be made available to distribute to the shareholders.
Yeah.
So I just want to share this with all you so that you see whether this rings some bell to you or not.
Yeah.
Right?
Good.
So yeah, after we talk about how to value stock, can we talk about different industry and sector in Bursa Malaysia?
Yeah. So for our Bursa Malaysia, we have different industry over here. So let me briefly run through. You have construction, consumer products, energy, financial services refer to the banks, healthcare, industry, products and services, plantation, property, REITs, technology, telco, transportation, and utilities. So among all these industries, different sectors, right? They have certain keywords of analyzing. So it is always a good homework for you guys is that you go to, how do you see the keywords? You go to their annual reports. So where can you get the annual reports? You can either get from the Bursa Malaysia website or other financial website that will give you the information about their annual reports by the brokerage houses. Okay, so they will give you the annual reports, and then you will read the lines. Okay, read the lines, and then you can see that for certain industry, this particular keywords always pop up. Okay, then these keywords are actually the key factors of analyzing this particular industry. So I'm going to go through three sectors, and then to show you some of the keywords. And then the rest you do it as your homework, and then you try to come up with your own keywords. Okay. So the first industry is the airline industry. So for airline industry, right, you will see that they will use the word load factors. Load factors measures the capacity utilization. So for example, you are talking about passengers. When you fly the flight, right? So you are talking about passengers in the transport, and then to fly from one destination to another destination. So for all those transport companies, right, they will have these load factors whereby it measures the capacity, how many people are on the board. Okay.
Like you're on board the aircraft, you see that is it 80% of the seat sold out?
Yes.
Or is it a full aircraft? Full aircraft means 100%.
Yeah, that's right. So for example, AirAsia is about 83%. Okay, so the load factors for AirAsia is about 83%. So for any airline industry, if you have about more than 80%, is pretty healthy. Okay, that means quite good. Then the next one for the airline industry is called available seat miles. This is American. Available seat kilometers. Okay, so for Malaysian, Asian, we always use kilometers. So it's called available seat kilometers. So,
ASK.
ASK, yes. So this ASK, how do you derive? Is actually using the number of seats available times the distance. Okay, using the number of seats available times the distance. So for example, can I use the drawing function?
Okay, sure. Well, let's choose another color.
Okay, so this is called a SK is equal to the number of seat, the number of seat multiply the distance in kilometers. The distance in kilometers. Okay. So for example, you fly from Penang to KL. One load of this aircraft has 300 seats. Okay, let's say 300. And then the distance from Penang to KL is, let's say, I don't know, 400 kilometers. I just simply say 400 kilometers. So what is the ASK? So the ASK will be 1, 2, 0, 0, 0, 0. Okay, 120,000. So this is the ASK. So for this ASK, right, you can use for measurement, like you can use to calculate the revenue per ASK. Okay, revenue per ASK or the cost per ASK. Okay, now what does this revenue per ASK? So for example, this Penang to KL, right? So for the Penang to KL, each flight, each ticket sell at 200 ringgit. If it's 200 ringgit, that means you are using this 200 ringgit times the number of seats. Let's say it's full house, 200 times 300 of seats. So that will be your revenue. Okay, so you use that revenue divided by this 120,000, the ASK, and then that will give you the revenue per ASK. And then you compare to the cost per ASK. Then you see whether this airline is making money or not. So for the AirAsia, the cost per ASK is about 13 cents. Okay, 13 cents. Then you need to find out what is the revenue. Then you see whether this company, airline industry, this particular company is making money or not based on this calculation. So this is important key measurement, ASK and load factor. And then of course, this unit revenue, unit cost, debt to equity ratio is quite common in all kinds of industry. Okay, so this is airline.
Okay, so you want to go next, right? Okay.
So this is just one example of American airline industry. So the load factors is about more than 80% on average. Okay, then the next one, the next sector, because a lot of you like to buy banking stock. So we look at the key ratio, the key terms in this banking industry. So the first one is called loan growth. So this one, I'm sure all of you know, so I don't have to explain much. It's just the growth of the loan. The next one is called gross impaired loan ratio, GIL. So this gross impaired loan ratio, the word impaired, you know that this loan is not healthy kind of loan. So you want to see that what is the percentage of this not so healthy loan in terms of the total loan ratio. So the industry average, right, for the Malaysia is about 1.5%. So then you need to, when you analyze the banking stock, you need to compare with other banks as well. So for example, we can see that I have the figures here with me, is that Public Bank for this GIL, right, is about 0.5%, which is below the industry average. And then the Maybank is 2.7, CIMB is 2.7. So from here, you can see that which banks are having a slightly high impaired loan ratio. So the higher, the not so good. You want the lower, the better. You want a healthy loan, right? Then the next one is called Tier 1 capital ratio. Now, Tier 1 capital ratio, what does this mean? So you have this definition. So basically for banks, right, banks valuation is different. It's because banks, they have their own assets. And at the same time, they also collect people's public's money to deposit into their banking system. So then you see that there's a confusion. Is it my money or your money? So therefore, you are divided into this Tier 1, Tier 2, and Tier 3. So Tier 1 is the core assets of the bank. Okay, core assets of the bank, the bank's own money. Whereas the Tier 3 will include other depositors' money, which is a bigger portion. So the important about this analysis, the banking sector is this Tier 1, their own money. So they want to see their capital ratio. So for the industry, right, it is usually more than 6% is good. So let's see for Malaysia, the Public Bank. Public Bank, we have about 12% of our Tier 1 capital loan ratio. So the higher, the better. That means you have more capital. Okay, so in terms of your own capital as a percentage of the total is higher. The more, the better. So for Public Bank, it's about 12%. Maybank is 13%, and then CIMB is 13%. So from here, you can see that the strength of the company in terms of their capital. Okay, so this is also important for the banking industry. Then, anything you want to say?
No.
Then we come to the third industry, which is the telco industry. The telco industry, the key term that people look at it are the average revenue per user. So average revenue per user is like on average, right? One user pay how much for the phone bill. So for example, I'm the Maxis. Every month I pay about 300 ringgit. So however, some people pay 99 ringgit, some people pay 49 ringgit. So on average, what is the average revenue per user? Okay, so this we will see. So if let's say the company is reducing their pricing, keep reducing their combo, their packages and things like that. So the price keep reducing. So you will see that the average revenue per user is reducing. So is it good or bad for that company? So it's actually not too good. Okay, you want to see increase, not reduce for revenue. Then you also need to know how many postpaid subscriber, how many prepaid subscriber. So these are their customers. So you want to see growing number of subscribers in this particular mobile company. And then you want to see capital expenditure, because for this industry, a lot of capital is spent on the capital expenditure. And then some, you have to see that whether it's yielding you money or not. So this capital expenditure sometimes is very difficult to measure because you may not know until years later whether it is giving you the reward. Then you want to know the customer experience index. So this one is the customers, how is there any complaints or not? Because for the service industry, you want as little complaint as possible. So this index will track the number of dissatisfaction among your customers. So all these are important in the telco sectors. Okay.
Okay, finally, yeah.
Yes, finally we come to the end of this webinar, and then let's do a quick recap. So basically today we have done quite a lot from scratch to pro, right? So I hope that after today's the webinar, right, you have a sense of feeling that you are a bit pro now, and then you can analyze the annual report a bit more, yeah, with confidence.
All right, so before we go to the question and answer session, let's do another poll. Okay, this is the last poll that we have. So which of the following is not a sector classified on Bursa Malaysia? Number 1, is it REIT? Number 2, is it consumer product services? Number 3, is it financial services? Number 4, is it energy? And number 5, is it warrants?
Oh, this one got to be 100% correct.
All right, so
it's very
please
easy.
give another 15 seconds. All right, 70% of you have voted. So let's close the poll and share with you the results. Okay.
Did we get 100%?
So no, we don't get 100%. 2% you pick REIT, 1% you pick consumer product services, 2% you pick financial services, 5% pick energy, and 20% pick warrant. So what is the answer, Pauline?
Okay, 90% of I see improvement here. 90% getting the right answer. So it's warrants. Warrants is not in our sector. It's not warrant. It's not a sector. It's just a product.
It's a structure for us. All right. So 90% you got it right.
Which is an improvement.
Okay, that's great. So it seems that you are paying attention. But then let's go to our question and answer.